So I've been talking to Johnson Chukwu, who is the managing director and economist of Cowrie Assets Management Limited, and we've been looking at the increase of the cash reserve requirement by the Central Bank of Nigeria on public deposits and how this has affected the economy. But we'll be looking at that in just a moment. Let's take a look at some company news we have for today. Now, for the 9 months ended June 30, Vitafoam Nigeria PLC declared revenue of 12.99 billion naira in its unaudited IFRS financial statement to the Nigerian Stock Exchange. The company reported a profit before tax of 712.80 million naira with taxation provision of 232.38 million naira. Now, another company on focus is Flour Mills of Nigeria PLC, and it was among 8 other companies that submitted their audited financial statements for the year ended March 31, 2013 to the Nigerian Stock Exchange last week. According to the company, its revenue grew from 258 billion naira in 2012 to 302 billion naira for the period on the review. Well, profit before tax came in lower at 11 billion naira from 12 billion, while profit after tax for the same period on the review remained unchanged at 8 billion naira. Well, as I said, we're still looking at the increase of the cash reserve requirement on public deposits by the Central Bank of Nigeria and its implications on the economy. And I'm still being joined in the studio by the Managing Director, Cowrie Assets Management Limited, Mr. Johnson Chukwu. Thank you so much for sticking around.
Thank you.
Well, just before we went on break, we looked at how this increase will affect exchange rate stability. Now, let's look at deposit rates. Some analysts believe that this will likely increase the amount being charged on deposit rates. Do you still share this view?
Absolutely. I did say earlier that the banks are increasing their deposit rate by between 300 and 400 basis points, and it could go higher than that.
How much higher?
It could go as high as 500 basis points. Some banks' highest borrowing rate or deposit rate was in the neighborhood of 8%. Right now, they are pushing towards 13%. Some of them are pushing towards 13%. That's 500 basis points. And what they are basically doing is that they are trying to replace or substitute commercial deposits for public sector deposits. And commercial deposits now have lower costs in the sense that you have lower cash reserve ratio. You see, what you have to look at the cost of the public sector funds. If, for instance, you take a public sector deposit at 5%, and you have to forfeit 50% of it, okay, the implication is that you are borrowing at 10%. Do you get what I'm saying? So that's the implication of the huge cash reserve ratio that is now imposed on public sector deposits. So it makes sense for them to go for commercial deposits at maybe something less than that 10% if they could get that. And right now they have 2 challenges. One, they have to restore their liquidity position, and they also have to restore their operating liquidity. You have the statutory liquidity ratio, and you have the operating liquidity. The operating liquidity, they now need to do their business, to lend, to run their operations, to make sure they have enough cash in their vaults, to make sure they have enough cash balances for for their daily clearing. So they need to restore both operational liquidity and regulatory liquidity. And I think some of them who are highly dependent on public sector are actually going through more difficulties. So you have some of the banks whose deposits base were highly skewed in favor of the public sector. And so what those banks have done is they have almost lost their entire liquidity. And they need to go to the market and begin to use price to see if they could mobilize commercial deposits.
Now, all of
retail
this
deposits.
we the retailers, the
yes.
retail customers are going to be affected. But now I should have asked you this earlier on. Let's understand the term cash reserve requirement as a monetary policy tool by the CBN. Okay,
the cash reserve requirement, or cash reserve ratio, is the proportion of a bank's total deposits that is kept with the central bank, such that should the bank require an urgent cash need, it will demand for it. So basically, what the central bank does is like a buffer. That's actually what it's meant to be. But it's now used as monetary policy tool to reduce the level of liquidity that the banks have or to increase it. When the central bank lowers the cash reserve ratio, it releases more funds into the banking system, into the banking vault. It avails banks more liquidity to trade. But when it increases the cash reserve ratio, it reduces. What it does is that it takes away that increase, that quantum, based on the percentage increase from the entire bank's total deposit base, and sterilizes it with the central bank.
Okay. Now, is this what the system needs right now? Is this what the banking system needs at the moment? Is it a case of it came at the right time, or should this have been announced long before now?
Well, I think what you will realize is that it came as a surprise to most bankers. Nobody was expecting. In fact, when I heard the announcement, I thought I heard 5%. I wasn't sure I heard 50%. So, but the fact of the matter is that the central bank has several tools to use in managing the liquidity in the system, one of which is the cash reserve ratio. Nigerians have actually been crying that the central bank should reduce the cash reserve ratio from 12% to below 12%. And what the central bank said is that we still have an upside inflation potential. The potential inflation risk is still high, so they cannot come down the cash reserve ratio. But beyond that, what central bank has done is to kind of move ahead of the expected additional inflow into the system from public sector. Like I said, the public sector is going to see the fiscal arm of the government. We're going to see a lot of liquidity injection into the system. So what the central bank has done is to move ahead of them to try to moderate the impact of that liquidity. But beyond that, the logic of the central bank is also this, that one Ministry of X lends to the banking system. Ministry Z goes to the banking system to borrow. Ministry A that have lent to the banking system is enjoying interest rate of 1% or 2%. Ministry Z that has gone to borrow from the banking system is paying 14%. So in effect, what that has introduced is kind of what they call armchair banking, where the bank managing directors do not really need. I mean, I had an encounter with the bank, but I won't mention the name. The banks do not need to go out there and scramble for deposits,
because they have the ones coming in from
they have the ones from government, which come to them close to 0%, and they are lending. They are using the same money to buy treasury bills at 13-14%.
Well, this money we're talking about, how much is it exactly?
I said they are about 1.3 trillion of public sector deposits
with zero interest rate.
With close to zero interest rate. And let's even say they are enjoying 10% on that. That's 130 billion. I mean, assuming they're enjoying interest rate of 10% only. The banking system gets from the federal government, the state government and local governments an average of about 130 billion profit for doing nothing. And all the central bank said, look, it doesn't make sense for government to continue to lend to the banking system at 0 rate and be borrowing the same amount that he has given to the government, to the banking system at 14%. So what will happen is that you're going to have a reduction in the bank's income because they're going to forego that at least 50% of that money they were making from taking money from the government. And you're also going to have a reduction in government debt service obligations because the government does not need to borrow from itself or borrow its own money and pay interest to the banking system. So on the public side, you're going to have a reduction in cost of governance in the form of cost of borrowing from to finance public sector. And then on the banking system, you're going to have the flip side of it, where the banks are going to suffer income loss. And unfortunately for the banking system, this is coming at a time when they are already suffering a lot of income pressure. Right now, the central bank has compelled them to cease charging for ATM. And remember that the ATM has a cost of servicing. It takes some cost to restore the cash, to maintain the ATMs, to provide the telecom service or network that provide, and they are in effect, on that angle, the banking system is subsidizing the banking public. Because central bank had to do that to encourage the inclusiveness policy. Might
this in any way cause another crisis? So should AMCON be on the standby that they might have to wade in anytime soon?
No. Why I said no, a categorical no is this. One is that the impact is not going to be as much as to lead to a banking failure or near banking failure. Again, it's a policy that could be reversed at any time if the impact becomes too severe. All the central bank needs to do is, at the next MPC meeting, reduce it to maybe 25%. So, and remember, this money is not lost. It's just going back to the vault of the central bank. So I do not think, as long as it's not, when the banks are not losing liquidity because they have created bad loans which they can't recover, but it's just that the increase in cash reserve ratio has actually reduced the level of liquidity they have. So it wouldn't cause a banking crisis as you mentioned.
Okay, so the announcement of this policy at this particular point in time is just right. It's just at least going forward in terms of how we expect or where we expect to see the banking sector in the next couple of years.
Well, I think it might be difficult at this. It's too early to call to say it's right or wrong. Let's see the overall impact on the banking system and the entire economy. If we are seeing a situation whereby liquidity, credit is being starved, the real sector is being starved of credit, or credit cost has actually increased to such an extent that borrowers cannot pay or cannot borrow or are defaulting, then we could say the impact is negative. But if we just see that over the next couple of weeks, through the open market operation, central banks are able to restore liquidity to the banking system, what the banks are only losing is their huge profit margins and the armchair style of banking, where they sit back, take government deposits and lend to government. And that reverses, then it will be positive. And maybe it encourages banks to go out there and attract those who are currently outside the banking system, and that will improve the banking system inclusiveness.
Well, in your opinion, for how long do you think this policy tightening should continue, at least for the CRR?
The challenge we have is this. The outlook, like I said about inflation, is that it's actually elevated. We have an elevated outlook for inflation. So that means that until the elections come and go, you might have the central bank continue to contend with managing liquidity. So you may not necessarily need to see a reasonable reduction, a drastic reduction in the cash reserve ratio or other contractionary monetary policies of the central bank until the elections of 2015 have come and gone. The public sector, the fiscal arm of the government, will continue in the immediate future to pump liquidity to the system so that they will actually show what the Nigerians call dividends of democracy, so that they can actually have basis to go back to the electorates sometime in 2015 to ask for the election. Until that era passes, we might have to contend with a lot of restrictive monetary policy from the central bank. So
it's fingers crossed for the money market, capital and the bond market as well. Thank you so much for joining us on the program and sharing your thoughts with us on the central bank's review of the cash reserve requirement on public deposits and its implications for the economy. Thank you so much.
My pleasure.